Guys, Akil Stokes here. Welcome back to another Weekend Trading Edge video, your weekly look around the market where I share a few of the top trading ideas that are on my radar for the week ahead, and of course some awesome lessons on how to become a better trader. Last week we did a longer video and I was a little bit worried that it would be intimidating, but thanks to your comments, you said that you do enjoy it. You enjoy the deeper dives even if it takes more time. So we're gonna follow up on that today. Now, before we hop into the charts, I do want to talk a little bit about what's on the radar fundamentally because it is a big week. We'll go into deeper detail at the very end of the video. That way I don't bore you to death with the fundy talk. But we have important things, right? And by things, I mean news events coming out Monday through Thursday. Monday, we have the RBA, so Australian interest rate decision. Tuesday, we have Bank of Japan governor speaking. Wednesday, we have interest rate decisions from both Bank of Canada and the FOMC, so here in the US. And man, if you haven't seen a Canada chart, wow. And then Thursday, what is Thursday? I think Thursday is Swiss National Bank. I'll have a graphic up, I'm sure, in the post editing. But 4 days of business, and if you guys are new, interest rate decisions are pretty much, and not pretty much, they are the biggest fundamental gear in the market, meaning that if we were looking at what news event affects the market most, it is going to be interest rate decisions, and then everything else is based off of how it affects interest rate decisions. So keep that in the back of your mind when trading this week. I would expect some kind of slow periods followed by some potential wacky news. And then we'll dig in at the end of the video of what I expect from each interest rate decision, because some are going to be big and massive. Some are going to be just pretty much nothing. So where to start today? Well, you should start by hitting that like button and subscribing if you're not subscribed already. Lots of awesome content here on the YouTube channel. Big reaction from the 10,000 hour rule video I did the other day, so check that out. But as far as trading opportunities, let's start on the euro dollar. This is going to be a little bit of a recap from last week, so bear with me. But I want to dive into this in a little bit more detail, specifically because of the interest rate decision that's happening here in the US. So U.S. is expecting an interest rate cut that should be negative for the currency. There's some other stuff happening too with new Fed chairs and whatnot, and the market's always looking for future guidance. So it's not necessarily looking at what's going to happen on Wednesday, rather what they say on Wednesday about what's going to happen many, many Wednesdays in the future. But regardless, we have a potential butterfly pattern here. I'll redraw this on from last week. And I'll talk about why this is important and may align with the interest rate decision. So our butterfly pattern looks like this, potential butterfly pattern looks like this. Swing high to swing low, X to A. Our deep retracement right here being our A to B. Our failed extension to the downside being our B to C. And then we spoke about in last week's video, for me specifically, the 127 inversion is where I like to look for the completion at. Butterflies and all pattern formations have really wide rules. What's important to you as a trader is, and I got a few questions about this with the Gartley as well, is knowing how you trade it. There's no one way to trade anything. If you look around the internet, you're going to see rules for this, you're going to see rules for that. Even if you look in some of these books, they're going to give you ranges where completion is in a range between this and this. Based on the rules-based trading style that we spoke about in previous videos, it can be very difficult to have a wide range of rules. All that does is introduce more gray areas. So what my mentors did for me, or for all of us, I guess, they weren't just training me, is they gave us very specific rules to follow. And that's how I train my traders as well. So just keep that in mind whenever we're looking at stuff like this. But the butterfly completion here would be a bearish one, meaning if price came into this 127, this is where you would look to sell. So if you're saying, Akil, if interest rate comes out and they're saying interest rate cut, which is negative for currency, if they announce or announce anything else about future cuts or whatever like that, that's also going to be weak for currency. So that would mean that this thing should be shooting up. Well, remember that the markets ebb and flow, right? Even when things go up, unless you are dollar Canada on Friday, right? Or unless you were the Canadian dollar on Friday, I should say. Even when things go up, they don't go up in a straight way, right? You can look at any move here on the market, they ebb and flow, right? And this last upward move, it went up, sorry, wrong tool. This last upward move, it went up and went down, and went up and went down, and went up and went down, and went up and then down, and went up and went down, eventually getting here. Even on the move before this butterfly, where this is obviously a down move from 119.20s all the way to about 114.50s, it didn't just go straight there. It went down, up, down, up, down, up, right? So the market takes breathers, right? Price goes up. It gets to a point where people like to take profit or not as many buyers are interested because it's too expensive. And then price goes back down. And when price gets to a cheap enough level, then it goes back up again. It's the general rule of supply and demand in the market, which is another really good video podcast episode you should check out if you haven't already. It's Supply and Demand for Dummies. Really good one, yeah. So think about it like this. So let's say we get that cut, and let's say we get information or the market believes that future cuts are coming. We should see a move like this. And if on a lower time frame, you can see an actually little kind of retracement and breakout pattern happening here as well. Now, why the butterfly is interesting is because the butterfly is a pattern which I like to call a relief pattern, right? In most M and W shaped patterns, we are trading within a previous level of consolidation. So in a bullish bat here, we have an X leg, which is kind of our structure level, our floor, and we should expect price to stay above that floor. In a bearish pattern like this one, right, it's the exact opposite. We have this W shape right here, and even if this is a Gartley, right, we expect price action to complete below this ceiling, so we have that protection. The butterfly is a little bit different because, as you can see, our X leg, our ceiling in this case, is right here, and it completes above it. So what the market is looking for in this particular pattern is a breakout, right? A big bullish move coming from our C leg, and then we're looking for that exhaustion point, right? So we're looking for the point where price has gotten so expensive that two things are likely to happen. One, the previous buyers said, hey, I made some good money, right? I traded it from down here to up here. That's a good trade. Let me start cashing out, right? Let me take some profit. Let me reward myself for my hard labor of looking at charts and trading the right position. That's going to be one thing. Two, or I guess three things. I'm going to add one, right? Two, there's not as many interested buyers at this level. Again, price was really cheap here. It was cheap here. It was even cheap here. And now we're at the very highs and it's expensive. And many traders are like, you know what? I like this as a buy, but it's cost a little bit too much. Let me just wait till it comes back down to earth, and then I'll buy it again at a cheaper price. And then three, there will be some interested sellers at this level. In this particular instance, we have a previous level of structure here. We have some more looking left. There has been selling interest in the past, so it wouldn't surprise me if there's going to be selling interest in the future. So you have that combination of less new buyers, previous buyers becoming sellers, and then new sellers entering the market. That's going to be that flip from the rate of buying pressure to the rate of selling pressure, and we should see some relief. And I use the word relief because I'm not expecting a move to be like this all the way down to here, but just a move kind of back to the X leg or maybe a little bit further, something like that. So this lines up with the butterfly pattern because that's what we expect in general in the butterfly pattern for this type of breakout. But also if we do see some type of big move from the news event, that's typically how those moves happen. I don't know if you guys have ever traded news before, but I always tell traders to stay out of it, especially if you're like a short-term trader, because what you see is this, right? You see, and let's go to Canada real quick for an example, and I'll come back to euro dollar. Again, Canada, close your eyes, right? Close your eyes on Canada. Canada had a big move, right? We just shot down, I don't know how many pips this was. We shot down from pretty much 139.50s all the way to, what is this down here? 138 even almost, about 150 pips, right? So how newer traders get into trouble sometime is they see this and they say, you know what, man, this was a big 150 pip move. I cannot get my buttons to work today to save my life. This is a big 150 pip move, right? I'm going to wake up and sell, right? This is the new trader. I don't know if I have a baby emoji. If I have a baby emoji, this would be baby trader somewhere in here. I'm not going to waste too much time finding it. I will. I'm just going to edit it out. Give me a second. 3 hours later, I finally actually found it. But these are the baby traders, right? These are the immature traders trying to chase the move. And then what happens is, as soon as they get involved at this level, get all excited about going short, what does the market do? it does this. Again, let me know if you've ever experienced this or witnessed this before. It does this. And then what happens is all these baby traders, they get scared and they're like, oh crap, I'm on the wrong side of the market, right? They were selling here. They experience enough pain, meaning the sell order is going against them, that they have to get out, and to get out, they have to buy. And then that's what new sellers need to get back involved in the market here. And then this thing rallies back down in the original direction, and then it just gets bad, right? So you see it all the time in the market, but that's what we're expecting here. That's what I would expect here with the euro dollar, as we have this these two events lining up. We have the bearish butterfly pattern, of course, which has the same type of philosophy to it, but we also have the potential move off of our interest rate decision, where I would expect to see a move up. Right? Not a great move up because the market does expect it to happen, but I would expect to see a move up, then a little bit of relief, and then after that, the market's either going to continue back down or continue back up and figure out what it wants to do. So it's a cool setup because it does align with, again, the expectation from this week's event. Next, we're heading over to the pound dollar, and this is going to be a little bit of a follow-up, but I did get a follow-up question based off of the CTS video that we did during the week. Now, pound dollar here on the 4-hour, we have two things setting up. One, we have the bat pattern, right? That is still in play. If you guys remember that, it is doing nothing, just consolidating at the highs as we wait for news to come out. So that is still in play. However, I would say if you didn't enter already, I would not enter because it is technically invalid, right? Because we broke, just one word, right? Above the X leg, this would no longer be a valid pattern for me. It's not one like, we spoke about the graceful exit in the previous video. It's not a graceful exit one where I would say you want to exit, right? It's still holding structure. But if you were a trader that didn't enter this before, it would no longer be valid to enter now, at least per my rule. So that was one thing. Now I'm still in this, so we'll see what it does. I hope it goes down. But that was one thing. What we spoke about during the week was the very tiny double top up here. We made a nice little CTS video. And I got a question from a trader saying, hey, Akil, because we had that spike up, this thing right here, is the double top invalid? And the double top is not invalid. Now, depending on your stop loss, you probably would have been stopped out, right? I know if I were trading this with the stop losses I use, I would have been stopped out on the double top. But technically, the double top is not invalidated. We did not break and close above that double top, so it's still valid. So I bring that up because this is still a potential trading opportunity. Now, will we get it or not with the news coming out? I don't know. I expect us to go sideways and do nothing until Wednesday, but here's what you can look for. This is pretty much the lowest level of structure here on this double top, excuse me. It was right here. We put in some new lows as we consolidated. This is the next level of structure that we would expect price to go to. This is an opportunity for either a 2618 or a 2618 type of trade. And what I mean by that is this. You can go down to a lower time frame with this as well. But if you're looking to get short here, I would wait for confirmation, and confirmation would be a break and close below this low line. A break and close below that low line, going back to the whole IPDE thing, right, allows us to make the prediction that price is likely to go lower. So that's step one. Wait for that. That's going to give us a prediction that price is more likely to do this after that occurs than what it was before it occurred. If you're a breakout trader, you can trade it right away. Again, there's millions of ways to trade. My personal style is I am a pullback trader. So I would want to see a break and close below. I would want to see a pullback into this level of structure, cheaper price, and then look to trade it down. Again, arrows are not working today. Look to trade it down to this level. So this is still a tradable opportunity here on the pound dollar. I would just wait for a little bit of confirmation first. Next up, we're going to head over to the Aussie yen. You're like, Akil, why the hell are we going to the Aussie yen? Because it is a very interesting trading opportunity. So it's bumped up in my list for the week. Let's go through that IPDE process that I just mentioned, because if you are new and unfamiliar, you need to know what it is. It's only the most important 4 words that you need in trading. But identify, predict, decide, execute. So I'm on the daily chart right now. This is my personal higher time frame, so I always start on the daily. But I want to identify what is price doing, what has price done, where is price at? And I can do that with a very simple tool, my horizontal line tool, perhaps my favorite tool in the market. And I just want to draw a horizontal line right at the higher price. And I just want to see what price did, right? So I zoom left, I can go to a higher time frame myself, and I want to ask myself, where is the previous level of structure? Well, our previous level of structure is right down here. Here are the highs. I'll make this a different color. And I want to ask myself, what has price recently done in relation to those highs? And I look at my chart and I say, well, you know what? Price put in a higher high, higher close. So because I identify a higher high, higher close, we have rules for all this stuff, right? That allows me to make the prediction, right, that price is likely to go higher. So right now I've given myself a bullish confirmation bias, right? Confirmation bias is pretty much you deciding your opinion on the market. There is a negative confirmation bias, there's a positive confirmation bias. A negative confirmation bias is something that I used to do back in the day where I had an office, I had like 3 TVs, a whole bunch of magazines, and I'd be listening to CNBC and Reuters and CNN and Bloomberg and everything I can get my hands on. And pretty much whatever the pundits were saying, that would spark my confirmation bias. So if the pundits were like, hey, you got to buy gold, buy gold, buy gold, buy gold, buy gold, buy gold, I'd go into the market like, oh yeah, baby, we're looking for buys on gold, right? It was no analysis on my own behalf. It was simply like these people that were experts were saying it, so I had to do it. And you can get confirmation biases in different ways. Like the internet is one as well. If you go on Twitter and everyone's talking about doing this, you're all of a sudden in your brain, you're like, I have to do that because everyone else is doing it, right? So that's a negative example of a confirmation bias. A positive example of it, and one that we want to have, is one where our confirmation bias is based off our analysis. So I want to get bullish here, not because I saw it on the internet or not because some pundit told me, right? It's because of my analysis. I see that I have rules for how I analyze the market first and foremost, and based on my rules, the chart is telling me that I should look bullish, right? So going back to the discussion about discretionary versus mechanical trading and how we operate in that subcategory of rules-based discretionary traders, this is a perfect example where I'm using my discretion to analyze the chart, analyze levels of structure, but I have very strict rules. Because this happened, I have to think this way. I can't look for shorts here. It is impossible for me if I'm going to follow my rules. So the prediction process, right? It's a 3-step process. 1, what direction is price likely to go in? 2, and the 2 are the main ones we want to focus on. 1, what direction is price likely to go in? Bullish. 2, if we go bullish, where are we likely to go to? And this is going to tell me whether there's an actual trading opportunity or not. So let's zoom back out and let's look at our next level of structure and ask ourselves, okay, well, where is the next level of structure? We can take a little trip through the market. We can start up here and say, okay, we went down here and then we came up here and then we came down here. And okay, well, let's just take a box right here. And we'll say this is one next level of structure, a minor one. And then we'll put a box up here at the top and say this is our major one. So I've just given myself 2 prediction points of where price is likely to go next. One is this level, one is that level. And of course, we would then do our magic and determine if one is more important than the other. We'd bring in some confluences to see where exactly within that level we can look for, right? We can do a kind of a short version of it right here, because we've been talking about a volume profile a lot. So I've been trying to give you guys as many examples as possible. And you can see that, okay, well, we have really a void, right? Right here, not a void. We don't want to avoid a space void, right? A void in the market. And then our volume picks up right about right here. So if we want to just kind of put on some loose marks right now, let's put one right at the volume spike here about 105.30s, and then we'll look for another one kind of right up here about 108 even handle. Just take the psychological number into account. So right now we have 2 predictive levels that we can go to, and we got to ask ourselves, well, as a trader, is there room for me to make profit from 103.14 to 105.30? That is calculator, even though it's already on the chart, you can see it, but for the video purposes, I'm going to act like I'm using a calculator. I can't find I had one. It's really dusty back here, so I'm gonna sneeze at it, but just, you know, it's upside down. And that's 15 pips. Is that enough room for me to make profit? Yes. Yes, right? It is. So yes, this is a tradable opportunity for us. So we've now put ourselves in a position where we've done the analysis, we've made the prediction, and we've classified this as something I can trade. So the next part of the process is going to be the D part, where let's figure out how do we have to trade it, right? And that's going to be different, again, depending on your rules. You spoke about this in the last episode, but the last chart about breakout, pullback, whatever like that. So you got to, whatever fits your fancy. But this is when I would go down to a lower time frame and I would say, okay, being a pullback trader in my own right, me personally, right, what I would look for is a pullback. I have a new structure high right here. Again, I'm just measuring out. I am horrible with the lines today, right? Measuring out the ebbs and flows, right? Here is our previous structure high up here. Here's our previous outside return right there. This is the zone in which I would look for price to pull back into. And if we pull back into that zone, then I'm looking for my reason for entry and a chance to ride it up to glory. So this is a really good potential trend continuation trade. The only negative, and I said I would talk more about this later, is that from a fundamental perspective, this goes against what we may see with yen, in that yen is probably going to come out and say we're going to start hiking interest rates, which would be strong for the Japanese yen, which this would be the opposite. This would be looking for a weak yen. But from a technical perspective, not paying attention to fundamentals, this is a really good technical setup. So next up, we're going to take a look at the Aussie New Zealand, and we're going to kind of go through this IPDE process again and show you a different type of scenario, or at least talking about that confirmation bias. So same thing here, I'm on the daily. Let's take a look at where price action came to. Let's put on our horizontal line right here. You can see the 116 even handle as well, and let's look left. If you guys remember, in the previous example, we saw that price action had cleared all structure, leaving the door open for a bullish continuation trade. In this example, however, you can see that we have not cleared structure. So going back to that process, before we identified that we had broken and closed above a previous level of structure, therefore we can predict a bullish continuation to our next level of structure. In this situation, we have not broken and closed above a previous level of structure. We are holding it. Therefore, I cannot look for a bullish trading opportunity, which means the only opportunity to look for, aside from doing nothing, would be a bearish one. So we have that bearish confirmation bias here. Now, we can see that price action came to that level, and we put in a nice little reversal pattern, right? Again, measuring out our ebbs and flows, bullish move up, a little bit of a double top right here, came back, didn't really break it, came back up to our highs here, held structure, retraced off of it, tried to push back up, failed, right? And then broke back down to the downside, breaking and closing below this level. Interesting thing here is, right, I wouldn't be surprised if we had some form of consolidation. This may end up forming a head and shoulders pattern as well, but you can see the consolidative junk right here. Consolidation often breeds advanced pattern formations. In this particular scenario, we have two things happening. We have an advanced pattern formation, and we also have a 3 drives pattern, which I haven't mentioned on this site in ages. And what the 3 drives pattern is pretty much, it's like, think about it like an AB equals CD pattern with an extra move, right? So if I take my line tool and I measure it from the high here to the low here, and I'm going to do 2 lines, and I take another line tool and measure it from the low here, to the high here, if I end up copying and pasting these moves, let's make this, what's a color I can use? Blue, right? You're going to see that we pretty much came to an equal length, right? The length of this first move right here is the same length of the second move right here, actually right spot on. Now, we often measure this out, but we don't measure kind of the retracement part. And when the market is moving harmonically, you're going to see equal retracements as well. So let's take this white line right here. We'll copy and paste it, and we'll drag it to the low of price action. And we can see that if we get an equal retracement up, it puts us at a pretty decent level where we've seen some selling pressure in the past. If you guys know how to read candlesticks, you can see the little clues that come with the wicks more to the upside versus to the downside, giving us the sign of some selling pressure right here. So this may be an area where price decides to sell off again. Now, if we were to put in another equal length move, right, and these things aren't always perfect. It may retreat right here at the 115 even handle, so you need to adjust this, but that would give us a move right down to this level right here. Now, I'm going to keep this blue line on here because this could be something else as well. If we go back to the very beginning and I add one more line from here to here, do you notice anything? If I take my Fibonacci retracement out and drag it from here to the highs here, do you notice anything? If I move this to the side and you see that this hit the 50% retracement, do you notice anything? Yes, we have a potential bat pattern as well on our hands, right? Lots of lines in there, but I won't delete them. I'll keep them on, but I'll make it easier for you. Swing low to swing high is our X to A, our impulse leg. Very smooth one, by the way, right? Our retracement back into our 50% level is going to be our B leg. Our failed extension up here is going to be our C leg. And for the bat pattern, we're looking for a price to go to the 886. And the zone of completion is from the 886 to the X leg. Now, I know what you're saying, Akil, the three drives pattern, the line you drew out doesn't come to the 886. It's a little above. Yeah, these things aren't perfect, guys. Man, you can't be that literal all the time. The fact is, we have some confluence. The bat pattern is the main signal for me, but you have some confluence with that potential three drives as well. And again, if we do turn around at the 115 even handle instead of retracing a little bit higher, then that puts it a little bit lower right at the 886. So, yeah, take that, right? So a pretty cool setup here, just from the harmonic nerd in me, not only having the bat pattern, which would be the thing that mattered most, and this is a bullish bat pattern, so you look for a move up, but having the three drives with it. Now, going back to the original situation, well, Akil, you mentioned that we are at structure, we should not have a bullish prediction. Isn't this a bullish prediction? Yes, you got me. But when we're talking about a bullish prediction, we're talking about a bullish continuation. So that would mean, like in the other scenario where we're looking for a price to continue, right, beyond the previous level of structure. With pattern formations, unless it's in a specific scenario where it's in alignment with the overall trend, we are only looking for a short move, right? The traditional targets here with these patterns are going to be a move pretty much back to this B leg. So I'm not looking for a move all the way up there. We're looking for price to move from pretty much like right here to right here at max, maybe right there. And that is something that can certainly form within a consolidative period because we're nowhere near the high. So although it's a bullish move, it's not a long-term bullish continuation type of move. So it's pretty much like playing consolidation back and forth. So pretty cool opportunity here on the Aussie New Zealand. Now, I got to take a quick break. You guys won't notice it because I'm going to pause everything, but I got to take the kids to church real quick because I'm recording this video late since I was away all week. I don't even know why I'm telling you this because I'll be right back and I could have just said nothing and you would never notice, but maybe I'll do like a shameless plug or something to break it up. So to break things up real quick, one of the questions I often get is, Akil, what type of system, what type of equipment do I need to be a trader, referring specifically to trading computers? Now me, I know nothing about technology, but I do have a great resource for you. You guys have seen it before here on the channel, but it is a free trading computer builders or buyers guide. Essentially what that means is that it is a guide that takes you through everything you need to know about trading computers. So if you're someone that wants to build one yourself, you know exactly what you should put in one. If you're someone that wants to buy one, you now know the different options of which you can buy, but it is a great resource that you can make the right decision based on your specific scenario. So click the link or scan the QR code. It's there, 100% free. It is my gift to you from Easy Trading Computers, who gifted it to me. Full disclosure, I had both of my trading computers built from them. One was about 15 years ago. The last one was about 2 years ago. So it gave me some pretty good running time. So I always want to give that stuff to you as well, just because, again, I don't promote a lot of things on this channel, but if there's something that I truly believe in, I do want to share it with you. And again, I know nothing about computers, so go to the experts, all right? Let's hop back into the video. All right, guys, back to the vid, and thanks to the magic of editing, you didn't even know I was gone. So next up, we're going to be on the Euro Aussie on a daily chart. This is going to be another counter trend trading opportunity. You can see that we have recently broken and closed below a previous level of structure. So if we're going through our IPDE process, we've identified a lower low, lower closed. Our prediction is that price should continue lower. However, when we get to the next part of our prediction, because remember, we're predicting which direction we're likely to go in, and we're going to see if there's actually a trading opportunity in that direction. And we ask ourselves, where is price likely to go next? If it does go lower, you're going to see that our zone is going to be right here. And because we're already in that zone, this isn't necessarily a great opportunity to sell because there just isn't enough room to make profit. Or there's always room, but it's not a high probability setup in my opinion. So rather than looking for a bearish continuation opportunity, I would look for a potential counter trend trade, asking myself, where in this zone is price going to run out of steam? And then once it does run out of steam, where is it likely to go if we get that little bit of a bounce? And again, following up on the CTS video that we put out this week on the channel, what we want to do as traders is we just want to look for different clues. There's rarely one thing that works by itself in the market, but if we can gather different pieces of evidence, like a good lawyer, we can make a better case and ultimately try to win the case. So, and there's many ways you can do it. Like for this one, obviously it starts off with the general prediction, but we can look at things like the RSI at the bottom of your screen, the relative strength index. It is massively oversold. The traditional oversold value of the RSI is going to be at 30. My personal oversold value is at 20. So I look for extremes, right? I like my drinks really, really cold or really, really hot. Anything in between is big, right? So when I look for conditions on the relative strength index, I want to see it extremely oversold, which is that red line at 20. As you can see, we are way past that red line. We are all the way at 10. So this would be a really extreme oversold condition. Something else we can add to the equation is maybe a volatility band, right? I like Keltner channels personally, but we can look at Keltner channels and Bollinger bands. These are pretty much volatility bands, which say, like, think of them like rubber bands where they kind of get expanded, and as they reach the expansion level, prices expected to kind of revert to the mean, which is that line in the middle. A Keltner channel and Bollinger bands act a little bit differently. I'll draw both on so you guys can see the differences. But in this case, we're hugging that outside band, and in both cases, we are trading well outside that outside band. So the expectation is that at some point, price will kind of revert back to that median line, which we'll follow in a little bit. So the point is, right, we are in an overextended market, so we should be on alert. Was my trading antennae? They look like rabbit ears. Now they look like bull horns, whatever. Anyway, a failed analogy. We should be on alert for a potential reversal period of relief in the market. So we don't have that right now, right? We're still, kind of moseying on down, but this is the area where you would look for price action to come to and then see if you can catch a little bit of a move, right, back up to the previous level of structure that was previously violated. Now, this next opportunity is going to be on Canada yen, and this is a very similar opportunity, but once again, we're going to be looking in the bullish direction, not the bearish direction, right? So I'm trying to explain different ways we can, so let's do it like this. My whole philosophy on the market, and it is the right philosophy, is that there's no such thing as necessarily bullish analysis or bearish analysis. There is technical analysis. And, we want to separate that from, many traders get in trouble because they're only looking for bullish opportunities. So they ignore a certain amount of information, or they're only looking for bearish opportunities and they ignore a certain amount of information. As technical chartists, as analysts, we want to take into account all of the relevant information for us. And analysis is general. We want to look at the market, we want to decipher the clues, and we want to make predictions of, hey, is it likely to do this or is it likely to do that? Now, once we've made those decisions, right, we can decide whether we want to be bullish or bearish. We can decide whether we can only be bullish or only be bearish, right? That's a whole different story. But in general, the analysis is the same. It's just using it differently, which is what separates traders. So I'm going to erase these volatility bands for a second, and I may bring them back on. But right now, going back to the four-step boring process that I'm going to hammer into your head until you hate me, right? IPDE, we see that price has recently broken and closed above a previous structure high, allowing us to make the prediction that price is likely to go higher. We have looked back and we can see that, guess what we also did? We violated another previous level of structure, so price is even more likely to go higher. And then of course we can identify our zones like we did in the past. Here is zone 1 right there. There's kind of a mini overlapping zone right here. And then the ultimate zone right up there that we would like price action to go to, or we would predict price action to go to. Just like before, we can bring in our volume profile tool, and hopefully you guys are following along. I know it's, I get comments a lot on the YouTube video where it's like, Akil, the reason you don't get as many likes or followers is because your content is all the same, it's repetitive and boring, and you don't show anything new. And like, yeah, that's trading, man. Reality check, right? There are many different ways, and we go over different concepts here, obviously, but like, it's trading, man. You do the same thing every time and you're consistent. Consistent analysis plus consistent execution equals consistent results. I don't know about you. I like consistent results. I like consistency in my profit. So I will do the same boring things each and every time if it continues to make money. And if I want to have fun, I will do stuff with my trading profits that allow me to have fun, not vice versa. But anyway, that's the difference between the YouTuber and, the trader that is on YouTube, right, versus the YouTuber claiming to be a trader, right? One is simply in for entertainment values and to hit you with bells and whistles, and the other one is actually trying to teach you stuff that matters. And, we try to do it in a fun way here, but we're not going to give you fluff just for fluff's sake, right? Anyway, let's burn our volume profile again to kind of see if any of these levels are more valuable than the other and not so much. So we'll worry about that later. But let's go back down to the 4 hour here, and we can see a few things. Again, one, we have the higher high, higher close. But we go down one more time frame to the hourly, and we can see a loss of momentum pattern. What I mean is this. If you look at the slope of our bullish move, very, 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 very steep up to here. And then you see how it starts to bend off a little bit, right? That is a loss of momentum pattern, meaning that if this were the ball reference where I usually have a ball laying around somewhere, it's all, there we go, sports nerd for you. If I were to throw this ball in the air, right, it would come out my hand with a lot of momentum. Eventually it would reach its apex and it would start to kind of bend off before going back down. And this is exactly what we would expect. Yeah, it worked perfectly here in the market. So we're looking for relief. And then you add that with the other things we brought in before. We have the RSI, once again, massively overbought, right? My traditional overbought is 70. And by traditional, I mean like default. It's not the best at all, but is 70. Akil's extreme overbought is 80. We are up in the 90s. We are in 92. What happened in 1992? AI tells me 1992 was a year of major political shifts, conflict, and cultural moments marked by, can't say this word, but some treaty that created the EU, Clinton's presidential election, Los Angeles LA riots, Rodney King verdict, Bosnian war, someone went to space, Mae Jemison went to space, the Dream Team at the Olympics, end of apartheid. There we go. We're getting some more positive stuff at the end of this. The UK's Black Wednesday, financial crisis. We're back down. And the rise of Barney and Friends and The Real World on MTV. What a year. Getting back undistracted, right? If we bring back on our Keltner channels and our Bollinger Bands here, again, you can see that prices not quite outside the extremes, but it's been hugging. Actually, no, I'm sorry. That's the line I drew on. Let's try that again. Yeah. So we are outside of the extremes of our Keltner channel, right? This is the white line. The measurements are a little bit different and my settings are a little bit different. And we were hugging the outside of the Bollinger Bands and now we're back inside. So if we are going to see some relief, right? Once again, you may say, Akil, if this stuff is saying that, hey, we may see some relief and price may go bearish, how is that helping our bullish scenario? Well, remember, what we're looking for is a pullback, right? I erase my lines, but when we get a break and close above, right, we're not looking to necessarily buy right there. As we spoke about all video, if you've been listening, is we look for the market to give us a little bit of relief, give us a cheaper price, and then we're looking to take advantage of buying opportunities at that cheaper price. So when you look at this and you're saying that, hey, the market is bending off, there's loss of momentum, we're outside our volatility bands, maybe other indicators are telling you stuff, we should go relief or we should have some relief. that is a benefit for you, because now you have to judge, okay, well, where is that relief likely to go to? And then what do I need to get involved in that move? So as some traders may look at this as a negative, it's actually a positive because it's setting yourself up for the next move. And as traders, what we're trying to do is we're always trying to think a few steps ahead. That way, when those steps do occur, we're not going crazy and bonkers and we don't panic in the market. I was 7 in 1992. I didn't care about any of that stuff. Now, the next scenario is going to be on the Aussie dollar. We'll run through this pretty quickly, but again, IPDE, identify, predict, decide, execute. You can see that we broke and closed above a previous level of structure, so our prediction is that we're likely to go higher. However, higher gets a little bit weird because although we broke and closed above this level of structure right here, you can see that we came right into a rejection zone of a previous candle, right? You can see it here on the daily. If we go down to the 4-hour, you can see it as well. So the question that we have to ask is there room to go to the upside, or have we reached the next level of structure? And this is a very confusing question. Now, for me, I'm a very cautious trader. I'm not aggressive at all. So I look at this and I say, hey, we're at the next level of structure. I don't want any parts of it. But you also don't necessarily want to leave trading opportunities on the ground or on the floor, whatever the term is, I don't know. So again, this is one where your volume profile may come in handy, because if we bring that volume profile on, it's going to tell us if this is a level that or give us clues that if this is a level that we should pay attention to, or if it's not as important as we think. So let's bring it on. I'm going to use the anchored one, right? So it does it automatically. I just click the top here. It's going to drag it right to the bottom already. And I can see that, well, the bulk of our volume, as expected, was in this consolidation level, but there's not really a lot of volume where we're trading at right now. Honestly, there's not a lot higher as well. So although I may have looked at this originally and been like, hey, this is a very important level because of that spike, one that I possibly need to fear, and maybe I shouldn't look for trend continuation opportunities because of that, the volume shows us that maybe it's not as popular as we think, and maybe the next popular level is actually at the highs of this bigger rejection zone right here. And what this does is it just unlocks an opportunity that you may have not had before, where in one case you're saying, well, I guess I can trade here, blah, 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 even if we pull back and give you everything you need. Maybe this unlocks an opportunity where it's like, okay, now I'm not as afraid to trade through this level, and I can look to take it higher. And I know you guys weren't a part of it, and I don't think I shared it in a video. I might have mentioned it in the CTS video that I put out for you guys this week. I do a lot of live rooms and stuff, so I forget what I talk about each day. But we had a really good conversation. It might have been the Q&A about grade A trades versus grade B trades, and kind of the different scenarios you can take in trading them. And one of the ideas that one of our traders in, I think it was a Q&A session, brought up was like, hey, if you have a lower CTS score versus a higher CTS score, if you have a grade A trade or a grade B trade, there's two ways to go about it, right? I always say that, hey, on your grade A trade, you could be more aggressive with how you enter because it's a better trading opportunity, based on whatever makes it a grade A trade. On the grade B trades, maybe it's still a trading opportunity, but you want to be more conservative because it's not as good of a trading opportunity. For those who are allowed to adjust their position size, you could do something else. You can do everything I just spoke about before, or you can adjust your position size. So on grade A trade with full size, meaning your normal position size. On grade B trades, maybe trade with half size or some type of percentage of your size. So it's still a trading opportunity that you can take advantage of and potentially make money off of, but because it's not the best of the best, maybe you're a little bit more cautious with how you do it. Think about it like for you guys that do any like sports betting or stuff like that. If you get a really good spread or something like that, or there's a game or a match that you feel really, really confident about, you may bet more money on it. If there's one that you're like, it's worth the risk, but it's not as great, you may bet a little bit on it. Same thing for poker. You have a really, really good hand, you bet more on that hand. You have a really, really not as good of a hand, but you think you still may be able to win, you still bet, but you just bet less. So those are things to consider in this scenario here as well. All right, we're getting towards the end, so hang on. I got a few more things to talk about, and we got to talk a little bit about the fundamentals as well, so I'll make these last two technical ones quick. Here on the DAX, right, the daily, we have a potential advanced pattern formation setting up. It's going to be a potential bat pattern. My X leg is going to start here. We have a very smooth swing high to swing low, and I want to draw my Fibonacci retracement from that swing high to swing low. That is going to be my A leg down here. So this is the starting move of this pattern. And then I want to ask myself, what Fibonacci level does price come to? And you guys know my rules are black and white, right? So you see this right here, and this spike, right, this B leg is very, very, very close to the 618 Fibonacci retracement. However, it does not hit the 618 Fibonacci retracement. So for me, this is still not a Gartley pattern because it needs to hit the Fibonacci retracement. What does hit mean? It means hit. It doesn't mean miss by one. It means hit to be a Gartley pattern. So instead, this is going to be a bat pattern, which I prefer anyway, right? So we're looking at a potential move like this. Swing high. I'll use this one so you see the letters. Swing high to swing low is our X2A. Our move right here is our B leg. Our move down here is our C retracement. And then for a bat pattern, as always, we're looking for a move to that 886 Fibonacci retracement and the zone going from the 886 to the X leg. So this is going to be a potential bearish, getting tired, bat pattern here on the DAX. And then just following that up, I'm not going to do new analysis. I'm just going to show you the same chart from last week. I'll erase some of this stuff here. We still have our potential bearish Gartley here on gold. So if price comes up into this zone right here, I got a question about Gartley's the other day. I'm going to explain that in a video this week, hopefully, but I'm looking for a decompletion at our 127 extension. And then again, a little bit of relief right there on gold. So as I mentioned earlier, we have a full week of interest rate decisions in the market, 4 of them coming out, kicking off on Tuesday, December 9th, whatever day Tuesday is. I think it's Tuesday, December 9th, with the RBA, the Reserve Bank of Australia. There is no expected change happening there, so that's going to be a hold. On Wednesday, we have the Bank of Canada and the FOMC, so the US dollar, right? The Bank of Canada just said to end last week that we are not going to make any changes. We are going to hold. We're not going to continue cutting. Now, I wasn't here Friday, so when I came back and saw it, my initial reaction is that we saw a lot of Canadian dollar strength simply because of the World Cup draw. They're not in a bad group. They got Switzerland. I think they got Qatar in that group. But then I saw that they could potentially get Italy, which is maybe scary, but maybe not scary because it's Italy. But after doing some more research, I realized it was that they actually came out and just said that, hey, we're not going to cut anymore. And that made a lot more sense than the World Cup draw. But yeah, you never know how these things affect market. There is a World Cup effect. We will see that this summer, and we will talk more about that. That is a real thing, believe it or not. Anyway, we're not going to see any type of cut on Canada coming up, but what we're going to want to pay attention to is their verbiage in the wording and if they give us any more details about their future plans for 2026. And that's what the market's going to be reacting off of. Now, the main event, just because the US dollar is the most important economy in the world, I'm not saying that because of any type of personal bias. It is what it is. It's the most traded currency in the world's reserve currency. Is going to be the FOMC interest rate decision on Wednesday for the US dollar. Now, despite still not having all of the economic data, we're going to have 2 jobs reports come out after the interest rate decision. So the Fed is still kind of flying blind, but there has been a consensus that we are going to cut. Now, just like Canada, what's more important than the actual cut or not, because again, the cut is the expectation. If for some reason we didn't cut, oh my gosh, run for cover, things are going to go crazy. But it is expected. They don't really like to ruffle any feathers. What's going to be more important is Jerome Powell's press conference afterwards, where he's expected to kind of lay out the lay of the land for the future. Although, again, we're laying out this lay of the land for the future without all of the data available. So it's still not going to be the full story, and I would expect more fluffery in his speech, but you never know. And lastly, Swiss National Bank, no expected change there. So it's technically a big bad interest rate decision, but nothing's going to happen there. So no one's going to care about it. Now, I often worry that no one cares about me, and that makes me sad. If you don't want to make Akil sad, you can make me happy by hitting that like button and subscribing if you're not subscribed already. Also, make sure you follow the Trading Coach podcast. It's available on your favorite podcasting app. However, I do recommend Spotify because they share both the video and the audio version. So if you're someone that doesn't like bouncing back and forth between Apple or YouTube every time there's a video version, which is quite often these days, just check it out on Spotify. That way you can get both in the same place. I hope this video was rewarding for you. If you have any questions or comments, leave them below as always. I wish you the best of luck in this potential rough water week of trading. And until next time, plan your trade, trade your plan. Take care.
I wanna be the best in the game, invest in my name. Check no restraints, I'm obsessed with the pain. I ingest, I retain, assess and I change. Possessed by the thought I'll be free one day from society's restraints. Money, clout and fame, mud, disease, a plague. We all love to hate, have to play the game, have to make a name. All our insecurities are on display.